Russell, welcome to the show, sir.
Happy to be here, Ellis. Thanks for having me.
Guys, I started this podcast to interview guys like Russell, experts like Russell. So it is an important time right now as investors in the world, in our economy. And so it is perfectly fitting to have Russell and his experience here with us. Russell, I mean, people know you're the real estate guy, host of the Real Estate Guys radio show. But just in light of maybe folks who aren't super familiar with that show or haven't listened to a ton, just your experience in this industry as it pertains to a real estate investor?
Well, I mean, first of all, I'm an old man now, so I kind of was coin collecting in the '60s when silver came out. I was watching live television when Richard Nixon took us off the gold standard in 1971. I experienced firsthand stagflation, the oil crisis, the existential threat of global cooling, which is what the problem was in the '70s. We were being told that we were going to run out of oil by the year 2000. So I've seen the central planners create or at least exacerbate crises in order to cover up the fact that their financial system was failing. So one of the major great resets that we had, since that's a term out there these days, was when the world came off the gold standard, when the dollar was no longer backed by gold. And that happened in 1971. That unleashed a big ton of inflation in the '70s, which I didn't really understand, but I did manage to buy my first property in 1979. And I was 19 years old at the time, and started my first business, sold both. And in the early '80s, I was experiencing this inflation and Paul Volcker jacking the rates up. He was the Fed chair at the time under Ronald Reagan, whose mission was to break the back of inflation. He was faced with a situation very similar to what Jerome Powell is faced with today, and that is this double-digit inflation. And so he raised interest rates. The prime rate went all the way up over 20%. My very first investment property I bought at 24 years old, my interest rate was 13.6, and it had positive cash flow. Wow. So then I kind of saw that happen in 1987. I saw the stock market crash, that Black Monday it was, I think it was, or Thursday, I can't remember, but it was October 19th, 1987. And my dad was a high-tech entrepreneur, and he lost a 8-figure fortune in one day. And I thought to myself, how could a guy who spent a decade building an 8-figure fortune lose it in a single day? How could that possibly happen? And so that began my loathing of Wall Street. And ironically, I was a registered representative at that time, selling mutual funds and variable annuities and things like that. I got out of the business because I decided I didn't understand what was happening, went back into corporate sales and started studying. And then I took another run back into the financial services industry, because I felt like the baby boomer demographic was going to be making their asset allocation shift from equities into bonds. This was my thesis in the end of the '90s, and that move would drive interest rates down. And we had a long history of interest rates coming down. I didn't understand the reason why I do today, which kicked off a bond to bull market, which has since come to an end. And that's another major shift that most people under 50 years old can't even comprehend, because they've been in a 40-year bull market for bonds. And I got into the mortgage business and had read Creature from Jekyll Island by G. Edward Griffin and understood the fatal flaws in our financial system. Decided to get into the financial education business alongside being in the mortgage business and being a real estate investor. And that's when I met Robert Helms, the founder and host of the Real Estate Guys radio show. I heard him on the radio like anybody else, went to one of his seminars. I began doing some business consulting with him. And then in June of 2004, I became the temporary co-host of the show, and I've been there for the last 18 years. So, and of course, along the way, we syndicated, raised money. We did real estate development. Today, we're the largest real estate developer in the country of Belize. I discovered offshore. I learned a lot about real assets, real asset investing, but I've always come at it from the economic perspective. I believe that when you're looking at world events, when you're looking at what's going on in policy, if you understand oil or energy, which is the economy, there is no energy, there is no economy without energy. And you understand gold, which is real money, and you understand the dollar, which is the world's reserve currency. When you understand the motives behind maintaining those things, the monopolies on those things, controlling those things, you understand about 90% of geopolitics, even what's going on in Ukraine and Russia prior with, Saddam Hussein and Iraq, what the heck we were doing in there after Afghanistan, Libya, Venezuela. There's a lot of things going on around the world that you think have to do with politics, human rights, communism versus democracy. It's none of those things. It has everything to do with oil, gas, and the dollar. And right now, there's this big thing going on with Russia and their decade-long collaboration with China to get out of the dollar system. And if you're an American investor and you borrow in dollars, you earn in dollars, you save in dollars, you denominate your wealth in dollars, and you only think of your financial life in terms of dollars, you may not be ready for what could be coming. Whereas the rest of the world, people in the rest of the world, they're used to thinking in terms of at least two currencies, their home currency and the dollar. A lot of people think in terms of their home currency, the dollar, and gold. But Americans are unique in their, I would say, ignorance of really understanding what's going on in the world and in the financial system. And I think if this thing turns, it'll make 2008, in terms of how quickly things change, look like a walk in the park. So it's a very fragile financial system we're in right now. And it doesn't mean you should be scared. It means you should be awake and beginning to position your portfolio to be on the winning end of any kind of a crisis that would come out of a collapse of the current financial system, the dollar as the world's reserve currency, or even as the dominant currency.
So,
And
Russell, let's break that down. And I think we will title this the future of the dollar. And let's just keep going on this train. We can come back to some of the things that are happening today as we speak, right?
sure.
With the treasury yield inverting. Let's come back to that though. I mean, someone's listening to this. You talk as if this could happen within the next decade. I mean, what would cause the dollar to collapse like that? I mean, yes, we have high inflation, but I mean, my gosh, it's not as we
Well,
see
high
in some
inflation is the dollar
countries.
collapsing.
So like talk about how that, I mean, that you talk as if it could happen fast. What do you mean for those who may be unfamiliar with even thinking about, oh my gosh, the entire currency in which the world seems to operate on could disappear?
Well, if you study the history of the dollar, as I have, dollar became the world's reserve currency in 1944, 1945 at a conference called Bretton Woods in New Hampshire. It's a hotel, and the world leaders got together and they reset the world's system. So prior to that, the British pound, or the pound sterling, was the world's reserve currency, and the London was the financial center of the world. And what had happened is this upstart country called the United States of America had a very dominant manufacturing economy, created real wealth, not faux wealth, not paper wealth, but real wealth. Goods and services made in the USA was plastered all over everything. And as the United States sold its goods and services, especially going through World War I and into World War II, we gathered a lot of the world's gold. We ended up with over 20,000 tons of gold. We had the biggest manufacturing economy. We had the biggest army. We had the biggest stockpile of gold. And we had some of the best natural resources, richest farmland in the world. We were by far the dominant superpower, not just by military strength, but by economic strength. But we weren't the world's reserve currency. And so what happened is Britain's economy collapsed as a result of World War II. And there needed to be a new world order, if you will, kind of another buzz phrase that's floating around. The baton was passed from Britain to the United States at Bretton Woods. And the deal was, okay, folks, we're not going to trade in gold anymore. We're going to trade in the dollar, but the dollar is redeemable for gold. And so even though after 1933, Americans weren't allowed to own gold personally, the rest of the world was. And so they would take their dollars and they could, if they wanted to, bring them to the gold window, like going to the teller at the bank, and turn in their dollars and collect gold. And so as the United States began to benefit from being the world's reserve currency, it was like giving a college student an American Express black card. We just kind of went crazy. And so we had a big boom and it was fun. And then we started going broke in the 60s. And so in the 60s, we had the Great Society, which was the beginning of welfare and the war on poverty. And of course, the old rule is anything you subsidize, you get more of. And that's exactly what happened. We had the Vietnam War, which was, the one of many. Once we had the printing presses, we were in constant war. War is profitable for bankers. And so the United States was broke. So we'd already taken the gold from the American citizens. So now we took the silver. So in 1964, I think it was 63 or 64, we passed the Coinage Act and we took all the silver out of the coins. And in 1965, what we got were zinc plated copper tokens. And so money and currency, which used to be one and the same, separated. And that was the beginning of the crisis that led to the United States breaking off the gold window. So on August 15th, 1971, Richard Nixon interrupted American television coming on, I think after Bonanza on a Sunday night, most popular TV show where he'd have the biggest audience, and announced to the world that the United States of America was closing the gold window. Our gold reserves had been drawn down from over 20,000 tons to just 8. And so he said, basically, the United States defaulted, but we were too big, too strong, too big of an army. Nobody could do anything about it. And so that was the beginning of people realizing, hey, this system's not good. So the Europeans said, hey, we need an alternative to the US dollar as a world's reserve currency. And they started going to work on the euro. That process began in 1971, but it was like herding feral cats, and they didn't get it done until 1999. So in 1999, the euro was announced, and Saddam Hussein immediately came out and said, hey, everybody, let's stop trading oil in dollars and let's trade oil in euros. And quickly, Saddam Hussein became public enemy number one. And it was just, not too long before he was taken out. And so, again, as I said at the top, when you understand the dollar, oil, and gold, you really understand a lot of the geopolitical things that have gone on and continue to go on are really attempts to protect the dollar's monopoly and to hide from the people the fact that gold, in fact, is real money. And the central banks are busy accumulating gold. And meanwhile, we get paper that they can print. And so free from that, the dollar, people began to dump their dollars and buy gold in the 70s. And what happened is gold went from $42 an ounce, I think, when Nixon broke the connection, all the way up to $850 an ounce. Gasoline went from 25 cents a gallon, which is what it was when I started driving, and it went all the way up to like $1 something. That isn't things going up based on supply and demand. That is the dollar collapsing so that it takes more dollars to buy the same goods and services. Anybody paying attention immediately went into debt and bought things that went up in value that were real. Of course, real estate was chief among them. And, back in 2004, 2005, Robert and I wrote a book called Equity Happens. And the basic thesis is our financial system is broken. The dollar is doomed to lose value consistently over time. In fact, the Federal Reserve, right on their website, says their mandate is to produce 2% inflation. That means you lose 2% of your purchasing power every year. Mm-hmm. The only way to beat that is to go into debt and buy things that are going to go up in value as a result of that falling dollar. And the real estate has been the central vehicle for hedging against inflation. And a lot of real estate investors have made money doing real estate. They just don't understand why it works in this kind of an environment. But these are the reasons why. These are the economic underpinnings behind why debt-driven real estate is one of the safest places you can go. You just have to make sure you manage the cash flow.
Guys, history. I mean, I think you just gave us about 50 years there, 60, 70 years of history in about 5 minutes. We'll have to go back in.
Well, there's a lot more. I mean, I tried to give you the abridged version, but this is all history that I didn't read in the history book. I lived it. I'm old enough that I actually lived it. And I don't know why, but from the time I was in grade school, I've been a news junkie, and I've been interested in economics and money, and, from coin collecting to becoming an investor. I mean, I was taking real estate classes in high school. So I don't know why I'm the way I am, but everything I've described, I read in the news, I watched on the news firsthand. I lived it.
So then translate that for us today then, Russell, is kind of what you're seeing. I mean, with the rise of crypto, we've talked a lot about cryptocurrency on this show, this kind of future of real estate and this new asset class that we brought in with cryptocurrency. Where do you see that as? I mean, this is new, I guess something since 2010, and now with the dollar, I mean, a lot of people talk, could cryptocurrency kind of be the substitute of that? What's your thesis on that? How do you see that playing into this?
I think that in a society, innovation is always going to occur. What do they say? Necessity is the mother of invention. And so when you have a currency collapsing, people try to figure it out. People go underground, they barter, they create alternative currencies. In a technological world, it's no surprise that somebody said, hey, we can find another way to conduct business. We can find a way to step outside the system. And of course, the people who monopolize the system, who run the system, who derive their control from operating the system, are going to try to cut off the escape hatches and continue to force you back in. So to no surprise, the Federal Reserve is working on their central bank digital currency. Every sovereign nation is working on theirs. Everybody is trying to figure out how to play in that space. At the end of the day, it's still the same concept. It's a currency, like current. It flows. That's why they call it currency. It's what facilitates economic transactions, money moving around, value for value. But any currency is supposed to represent value. It's supposed to represent goods and services, labor, commodities. In the old days, you used to be able to redeem that currency for the underlying asset. So that's what gold was. If you go back and look at dollar bills from before 1965, whatever it was, they were silver certificates. So you could take them in and they were redeemable to bearer on demand, an ounce of silver. So I would take a dollar bill and go into the bank and walk out with a real silver dollar. The dollar bill wasn't money. It was just a claim on money. And all currency is a claim on value. So the question is whether cryptocurrency of whatever type will be considered in the marketplace as a legitimate claim on value. If people will take it, it has value. Which one is going to survive, how it's going to work, I don't know. I'm not smart enough to know that. I do think blockchain technology is a thing because it's decentralized. And I think in a world of extreme central planning and consolidation, free people worldwide are going to look for alternatives. And I think that in it of itself will create a demand. Then it's just going to be a matter of which technology and which basis is going to be able to survive the government's attempts to control it and which is going to dominate in the market. So I think there's a lot of people who are smarter than me that are paying attention. Is it going to be Monero, Ethereum, Bitcoin? Is it going to be some new currency based on one of those platforms? I don't know, but I think it definitely has a role to play. I think any smart investor needs to pay attention to it. But I also think that you have to remember the thing that has resilient value, timeless value that transcends governments and financial systems and government regimes and all kinds of things are going to be real assets, right? Real estate is always going to be worth something because people need it.
Right.
Housing is always going to be worth something because people need it. Food is always going to be worth something because people need it. It doesn't matter if you're just trading thing for thing or you have some medium of exchange, dollar, yen, euro, Bitcoin, gold, puka shells, banana peels, whatever everybody agrees on, there will be commerce. And so you have the economy, which is the commerce, exchanging value for value. You have the currency, which is the medium of exchange. And then you have the financial system that supports that commerce and the flow of that medium of exchange from party to party. I mean, that's an overall economy, financial system, and currency. That's what we operate in. If you can just bear it down to its bare structure and then just realize everything we have is just magnitudes of complexity, but variations on that core theme. Currency, medium of exchange, which is a medium of exchange, economy, which is exchanging value for value, and a financial system, which kind of facilitates that exchange. That's what a basic system is. And when you see components of that basic system failing, whether it's the currency, which I think is a thing right now, or the financial system that supports it, which I think is also a thing right now, the one thing that you can count on is there will always be an economy because people will always be hungry. People will always need energy to conduct business. People will always need places to live. And if you stay focused on those core essentials, the basics, then no matter how badly things go, as long as you have the right to own property and conduct business, which is a whole different thing because a system that doesn't allow you freedom, there's no wealth without freedom. But as long as you focus on those basic things, you're going to be better positioned than the people who are really out on the bleeding edge and counting on fads and things that really aren't enduring. I would focus on things that are real and essential right now. And those are energy, food, housing, precious metals.
Because
And you could make the argument maybe Bitcoin is going to fall in there, but I would consider that more of a speculative play still right
right.
now for me.
Makes sense. I mean, essentially, what to not to sum up all that you said, but what I'm hearing, and I think important for investors listening to this is Russell's point is that the dollar is there's nothing backing that except what the value that we as the consumer maybe place on it and what the government says it's worth is why we want to trade that for real assets, something that actually does have real value because we know people will use it. And so so let me ask you this just point blank. I mean, do you see a scenario in the next 10 years where we're not on the dollar anymore? Where I mean, is that possible in that short of time
It's very
where
possible. It's absolutely very possible. In fact, Jerome Powell just came out a couple of weeks ago and said that, it's not inconceivable that we could have a world that had more than one reserve currency. Jim Rickards, in his series, starting with Currency Wars, has been talking about the drive towards replacing the dollar for international trade with an SDR, which is just an acronym for special drawing rights, which was a fabricated another form of fiat money, if you will, that would be used with international commerce. And what we've done by using our dollar and financial system, we've weaponized it. As you know, you've seen the sanctions on Russia. Russia's nobody's fool in that regard. They had already begun divesting themselves of US treasuries. They had already begun working with China and other countries to have bilateral trade agreements. They have already said, we'll sell our energy, which is a real asset, and only for rubles or gold. We won't take the dollar. So there's already beginning the process of the world moving away from the dollar. China set up the Asia Infrastructure Bank to be a source of capital for sovereign nations to build critical infrastructure in their Silk Road initiative, or their Belt and Road, whatever it is, the big trade route they're building. They basically took everything that the United States did to become the world's dominant currency, and China's been copying it, systematically putting all the infrastructure in place. And Russia and China have been driven into each other's arms through US policy. And together, they're strong enough. Russia is a major military power. It is a major energy producer. China is the major manufacturing company, and they have been busily buying up commodities and resources and agriculture all around the world to put themselves in a position to be what the United States was when we were anointed world's reserve currency at Bretton Woods. And so whether it happens by an agreement like a new Bretton Woods, where everybody comes together and say, hey, guess what? We're going to shift the world's reserve currency from this country to that country, or whether it just happens by default, as at the street level, people go into Bitcoin and they withdraw from the dollar, and people at the street level begin to buy gold and withdraw from the dollar. And as sovereign nations begin to stockpile gold, which they've been doing, and sell treasuries, which they've been doing, and then they begin to set up alternatives to SWIFT and the other U.S. systems, and begin to conduct commerce in their own currency without going through the dollar. We've already seen the dollar's dominance in international trade go from something like 80% down into the low 60s. Okay, and now it's not like any other currency is anywhere near close, but the trend is obvious. And the thing is, I did a presentation on this exact thing in a conference we produced in 2016 called The Future of Money and Wealth. And I chronicled through news articles available, mainstream news. I wasn't even going to alternative sites. I'm talking, Reuters, AP, Bloomberg, mainstream sources, and chronicled the whole thing, that you could begin to see this process. You're not going to unseat the US dollar or the United States as the dominant superpower in a day. But a lot of people right now are waking up to what's happening, but the seeds of inflation, the seeds of the dollar's demise, the seeds of the world casting off US dominance, that has been going on for a dozen years, that I've been overtly paying attention to it since the great financial crisis. And I've documented all of that in a report I wrote in 2013, the follow-up presentation I just alluded to at The Future of Money and Wealth. And so I'm happy to make those resources available to your listeners, because I think the word needs to get out. And I don't think people need to hit the panic button. I think they just need to be paying attention. It is going to be a wealth transfer between the people who are aware and prepared and the people who aren't.
Right.
And, you can say, well, that's not fair. I would agree with you. It's not fair, but it's the real world. So the choice isn't should it happen or should it not happen? The choice is what's going to happen to you. Which side of it are you going to be on? What are you going to do? And the Les Brown, personal development guy, has this great quote, says, better to be prepared and not have an opportunity to have an opportunity not be prepared. You paraphrase that and say, well, better to be prepared for a crisis and not have one than to have one and not be prepared.
Yeah.
If we prepare our portfolios to withstand the collapse of the US dollar as the world's reserve currency, or if we were to experience hyperinflation, or if we were to see the United States lose its dominant position in the world, and we're prepared for that, and it doesn't happen, probably no big deal. But if we're not prepared and it does happen, and it could happen quickly. And
well,
then
because what you're saying, even if we are prepared, then fine, we're sitting on real assets in an inflationary environment, which means the equity of those assets are only going to continue to increase. So the worst case is inflation does increase, the asset prices go up. The worst case is the dollar it disappears, and then we're still left with hard assets that the economy still gives value to because they're using.
Yeah, you want to own things in the system, outside the system. You want to, own things that are denominated in dollars and things that aren't. Like gold isn't denominated in dollars. Gold is gold. You can denominate it in any currency because there's a bid on any currency for gold. If you own, some real estate free and clear, that can be okay. If you have it with debt, it can be even better as long as you have the equity, maybe in something like precious metals, or you could make the argument in Bitcoin. I mean, if you would have, 10 years ago, taken equity out of a property and put half of it into an interest-bearing note to cover the debt service, and taken the balance and put it into Bitcoin, the growth on Bitcoin would have completely paid the property off. Now you'd own the property free and clear. That's the benefit of inflation. Well, gold can do that for you. Energy can do that for you. I mean, we have people that were buying energy when energy production, like leases on energy producing wells, when oil was minus $40 a barrel. Because the people who own those oil wells were being destroyed. They were crushed and they were in distress. And so you go in and you buy that production. We have a guy we work with that bought oil production at 6 cents a barrel. Oil's at $100 a barrel right now. Think about the profit margin on that. It's insane. But you have to be willing to, be a little contrarian if you know what you're doing.
Yeah.
You have to just understand what's happening and where you're at in the cycle. Is energy going to stop being needed? No. It's not. So the fact that you had this weird anomaly where we had such a glut of energy, there was a negative bid, it was a buying opportunity unless you thought energy was dead forever. Well, of course it's not. Real estate's not going to be dead forever. We had a real estate crash right now. I would think that people who are savvy are sitting on cash or ready to go shopping. This is a time to start improving your liquidity. People that, the dollar's falling, cash is trash. Well, yeah, but not really, because remember, when things fall apart, things go on sale. And so the time to trade your cash is not when it is weak, but when it's strong. And so even though the trend may be long-term down, there's going to be periods of time where it gets very strong. 2008 was a period of time where cash was king, right? The dollar has fallen, obviously. I mean, you look at what the price of a house was in 2006 versus 2022, the dollar has collapsed a lot against real estate, but the time to buy it wasn't at 2022. I'm not saying you shouldn't, because it could collapse worse, but the best time to buy it would have been in the crash. It's just hard to do psychologically.
Yeah. So by the way, guys, Russell's been very generous to provide some of these resources he's talked about today. We're going to link all of those in the show notes. First, I'll reach out to you to make sure I get those from you, and then we can link those below so that people don't have to. The links will be down there if that's the easiast way to do that. Unless you have one place.
They can just send an email. Let's see, future of real estate. Let's call it Ellis, ELLIS, Ellis at realestateguysradio.com. And I'll set it up when they send that email. I'll just send them links to all those resources in one email.
That's an email they need to send, or that's a website they can go to?
Email, super easy.
Okay, Ellis at
realestateguysradio.com.
By the way, guys, that's not going to me, even though that's my name. That's going to go to Russell. He's going to get you these resources. Russell, with the time we got left, I do want to ask you about the 2 and the 10-year yield curve, which has just recently inverted. I think it's bounced back up now, very little though. And that's always been an indicator. I say always, historically, a good
Nine out of
indicator
10, nine
of
out
a
of the 10 times, the
right,
last times that it's happened, it's been a recession.
of a recession. You give me your thoughts as an investor. Like, I mean, you've seen a lot of these, right? So, I mean, just speak to what that means and how do you prepare as a real estate investor when you see that? I mean, we still have a ton of liquidity in the markets. Interest rates are low. I mean, what do you think about this right now? Give me
Well,
your
I mean,
your take.
I pay attention to the bond market, but I don't pay attention to the bond market the way a stock trader pays attention to the bond market. And so people who are concerned about the yield curve inversion are people that are typically trying to decide between equities and bonds, and is it risk on or risk off? And everybody's investing for capital gains. But what I see is in a recession is job losses. I see wages getting weak. I see, and that has an impact if you're investing in real estate that is depending upon a working class demographic. That problem is already here because your working class tenants right now are facing double-digit food inflation, double-digit energy inflation, rent increases, very, very difficult. You know, some of the things, the moves that we make is obviously affordable markets because people are moving. If you look, the most recent home value appreciation just came out, and even though all markets are up, you see markets like Chicago and San Francisco, places like that, where it's only up 20% versus places, you know, like Phoenix and Tampa that are up considerably more. And that just tells you that from a supply and demand dynamic, you got inflation everywhere, but you have a disproportionate amount of it landing in affordable markets. The other choice is to move into asset classes that cater to affluent people. We promote the Guarino clan and residential assisted living because they teach people how to set up single family homes to cater to fairly affluent people that need a place to put mom or dad, and these things cash flow like crazy. We do resort property development, and so our demographic is overnight rentals to rich people who are on vacation. Those people benefit from inflation because they own stocks and assets, other assets that are going up. Another one would be short-term rentals. It's a way to create rental income on a nice quality property doing business with an affluent demographic. You know, a lot of money is piling into apartments, which I totally get. Cap rates are super compressed, which I think most people know. The odds of being able to bail that out with aggressive rent increases or aggressive refinances into lower interest rates, I think you really, really, really need to know what you're doing if you're going to be an apartment investor in today's market, because your demographic is really being victimized by what's going on. So to me, that's what recession means. So the yield curve is interesting, but I really pay attention to the bond market more from the standpoint of the health of the financial system. If interest rates rise, just like if cap rates rise, then that means that the value of the underlying asset drops. So when interest rates rise, bond values drop. So all those trillions and trillions and trillions of dollars of bonds that are sloshing around the system right now are losing principal value because of rising interest rates. And if a lot of those have been leveraged, meaning pledged like for collateral, because this is what the bond traders do, they buy the bond, they don't buy it for the 1 or 2% yield, they buy it so they can pledge it as collateral and then get borrowed money and invest that money, and now they're able to make higher rates of return. We all know as real estate investors, you goose your ROI if you can use borrowed money. And we use real estate as collateral. The difference is real estate investors don't get margin calls if the price of the property goes down. You still have to make the payment, you risk foreclosure, but you don't have to make the margin call. The problem is when you play that game in the bond market, if the bond prices drop, you do get margin calls.
Right.
And when you get margin calls, now you have to either sell at a loss, which sets a comparative value, like an appraisal. You know, if you have distress in a market, values drop, and it affects every property in the marketplace based on appraisal. Well, same thing happens in the bond market. And if you have too many people selling, you have a drain on liquidity. There's not enough cash in the system for everybody to be a seller. And so this is what happened in 2008 on a relatively small basis compared to where we're at today. And so I think the big threat that people need to be paying attention to is not whether the yield curve inverted or not, but really the strength of the bond market. And if bond values are falling, and you'll know that because you'll see yields rising, interest rates rising, then you have to ask yourself, is that going to create a liquidity crisis? Is that going to create a downward spiral of people selling on margin calls? And that'll show up in the repo market. And we had a big repo crisis at the end of 2019. And then if it does, then it'll take the credit markets with it. And when that happens, there will be a period of time where credit won't be available. Real estate investors will feel that, because the minute the influx of fresh money into the real estate lending world hits, then purchasing power comes out and prices come down. We have already seen the Fed back way up on their mortgage-backed securities, through the tapering, which means they're not pumping money directly into real estate like they have been for the last dozen years. So as real estate investors, there's a lot of things to pay attention to. It doesn't mean you need to be scared. I would be getting equity out of properties right now while financing is available and equity is there. I would be positioning that equity in a position in a place where you're either directly deploying it into affordable markets with solid cash flows and good fundamentals, or sitting in cash and waiting for this thing to break and then go shopping. So it doesn't have to be bad. It's just, I don't think going to be status quo.
Right. And I think that's such a great way to end too, because what you're saying is it doesn't, my wife's like, well, what does all this mean? I'm like, well, should we stop buying real estate? No, real estate is still a great asset. It's how you operate that real estate. Are you banking on, I have to get out in 3 to 4 years on a compressed cap rate, right? Am I banking on someone else getting better financing than I'm purchasing today in order to get out of that asset? Because if so, then we're in trouble.
That's right. Exactly.
If not, then we're okay. As long as we can hold on to that, we're protected. We have multiple exit strategies and we're cash flowing in affordable markets. We're still holding assets. So I really appreciate the way you just kind of drew outcomes to that and what we need to be paying attention to as real estate investors. So thank you. Besides the email, Russell, where else?
realestateguysradio.com. Basically, we put out a weekly podcast. We do some things on YouTube. One of the things folks might be interested in is we last year did I think a 14-part series on precious metals, and really we focused on silver, which I think was really enlightening because I took it from kind of a layperson's approach. Silver series at realestateguysradio.com. They can find that. It's free. And so we have our YouTube channel, we have our podcast, we do our events, as you know, a few events. We have our annual goal setting retreat called Create Your Future. We do that every January. It's going to be in Las Vegas in January 2023. Twice a year, we do Secrets of Successful Syndication. We teach people how to raise money. Our mission is to help Main Street invest in Main Street and defund Wall Street. And so we want to train up thousands and thousands of real estate syndicators. If you know how to make money in real estate and the only thing holding you back is you don't have enough cash, there are a lot of people with a lot of cash out there who don't want to get their hands dirty, and you can provide a valuable service. So that's what syndication is all about. And then we do an annual sales training we call How to Win Funds and Influence People, which is really how do you build strategic relationships? How do you sit down one-on-one with an investor and actually raise money? Because you can't take them for a test drive. There's specific skills. And that's kind of our portfolio. The rest of it is we just promote our network. We have people in our network that are doing great things, that are experts. They can teach you how to do apartment investing. They can teach you how to do residential assisted living. They can teach you how to do, various things. We're always short-term rentals. If you're interested in learning how to do that, just check out our provider network. We have those people, many of whom we've been working with for years, and we have a good track record. They've produced a lot of successful people. So, but yeah, we've been at this since 1997. So we definitely the old guys on the block.
I love it, man. I love
not slowing down.
Thank you for your time, Russell. Guys, realestateguysradio.com, and take his advice wisely today. Begin to think about, what your portfolio looks like. If you're following traditional wealth building advice, the chances of a traditional financial advisor understanding what we've talked about today is pretty unlikely, I would say. And so just pay attention to that. So Russell, thank you, brother. And I look forward to seeing you again in the future.
Thanks, Alice. Appreciate it. Keep up the good work.
Thank you.